So if you are an avid fan of the show or somebody who tuned in the last couple episodes, you probably know that we made some predictions that ran afoul of what the market was thinking as it relates to the mortgage interest rate environment.
I mean, the Fed decided to cut 50 basis points, so everybody got excited. Mortgage
Mortgage rates are going to drop.
Oh my God, house affordability is gonna get better.
Yeah. We're going to be able to buy more home on a lower rate because that's what all the realtors out there are saying is going to happen.
Oh yeah, man.
And we're like, yeah, I don't think so. We have this thing called the yield curve inversion. We were coming out of it, and I kept telling everybody that the mortgage rates typically track the 10-year treasuries, the bond market, and they'll most closely follow the 10-year. And the 10-year's got to get out of the inversion a couple different ways, and one of them is the bottom could drop out of the lower end of the curve, the 3-month or the 2-year treasuries.
Yeah.
Or the 10-year treasury could rise, or they could both rise, and the 10-year could rise more, which is probably the most likely scenario.
Right, because there's a big misconception, right? So a majority of people out there that aren't too familiar with the space is when they start to hear commentary of the Fed's going to cut rates, they think, oh, if the Fed's cutting rates, then rates for everything across the board are going to come down.
Yeah, no, it doesn't work that way.
Except just like Chris said, mortgage rates tend to follow the 10-year treasury yield, right? They're closely tied to that.
Mm-hmm. So, and look, I get it. People say, ooh, bond market. And people are like, oh, my God, scary, intimidating bonds. Ooh.
Yeah. I don't understand it. I don't want to know. Yeah.
So let me simplify the whole thing so to make it really easy, okay? Bonds are basically guaranteed debt by the government. Generally speaking, if people feel really, really comfortable with the long term, your 10 years are going to give you a good return because over 10 years of an investment, you're going to get a good return because if you make an investment for 10 years, it should pay you something good. If anything, it should pay you something better than an investment for 2 years, right? Mm-hmm. The longer you're in something, the more it should return. Otherwise, there's no real incentive to investing long term.
Right.
Believe it or not, that actually breaks down the bond market to its very core essence, right?
Mm-hmm.
Okay, Daddy?
Yeah, I like that.
All episode long.
You call me Daddy.
Maybe we call him Daddy podcast?
The Call Him Daddy podcast, that's right there for us to take.
I mean, we could sell it to Spotify for $50 million, not $100. I mean, it's a discount, right?
Yeah, I mean, how much of it? I mean, we're kind of like taking away the likeness a little bit.
And then we have a whole gender equality lawsuit.
Yeah.
You know, you can't pay her more.
Yeah.
Because we're dudes.
Call him Diddy? No, can't do that.
Call him Diddy podcast? Yeah, that doesn't make sense.
Yeah. Or hashtag no Diddy?
Probably he probably owns a copyright to Diddy, I'm imagining.
Yeah.
I'm assuming. Can you imagine if his lawyers sue somebody for copyright infringement? So I posted a short today, which I played part of Diddy's Bad Boy.
Yeah. It was real short.
It was less than 10 seconds.
Yeah.
I did it on purpose because I was trying to get around the algorithm flagging it.
Yeah.
The algorithm didn't flag it.
Yeah. Well, the music portion was even shorter than that. It was less than 3 seconds.
No, it was closer to 10 because the whole clip was 20 seconds, and I played it for about half.
Really?
Yeah, I played it just when he started speaking, then cut it off so that it wouldn't trick the algorithm. At least I hope it wouldn't. It didn't.
Nice.
So, yeah, basically we're over here committing copyright infringement. It's pretty much long and short of it. So the bond market essentially boiled down to its core essence is simply, as I stated, right? Mm-hmm. It's if you have more confidence in the long term, you're going to get better return over the long term. If you have less confidence in the near term, you're going to get worse return in the near term. But overall, the longer your money's in any investment, it should return more money. So typically speaking, if you've got a 3-year bond, or a 5-year bond, the 5 should pay you more than 3. Mm-hmm. You got a 10-year, 10 years pay you more than the 5. And that's usually the way it works, right? You have 3-month, 2-year, 5-year, 7-year, 10-year, all the way up. They should all pay you incrementally more because your money's tied up for longer.
Right. And for the greater portion of the last, I don't even know how many years, we had an inverted yield, right? So the 2-year treasury was higher than the 10-year treasury, meaning there was significantly more, hesitation or doubt with the market. Uncertainty in the short term. What's to come in the next 2 years? Hence, rates were higher, right? Mm-hmm. So and less in the 10-year. Now it's come out of that inversion, making people feel a little bit more comfortable with the short term because they can expect what's to come versus the 10-year.
So what happened is that the rate cuts were coming, and the rhetoric on social media everywhere, every real estate guru, all the gurus, my favorite, were like, "Hey, man. This is fantastic. The economy they're going to cut rates. The mortgage rates are going to drop. It's going to be a run. It's going to be fantastic." And what happened during this time? Well, in the course of just a couple of months, we went from $1.14 trillion of credit card debt to over $1.36 trillion of credit card debt. Jesus. When you think about the context of how many trillions that grew in such a narrow window of time, there is a clear disconnect between what Jerome Powell is saying with American savings and what we're seeing in the credit card spending. Because you recall from the last show, episode 250, Jerome Powell was literally saying, oh, you know what, man? They're able to save more because inflation's down. The consumers are having less wage disparity issues. They can make more. None of that appears to be true if you're looking at credit card spending and balances as a proxy for the macro problem. Mm-hmm. So people were hoping that the mortgage market would soften up a little bit and that things would improve. Well, we said very clearly that we did not think that was going to happen, that we thought mortgage rates were going to stay where they were. Matter of fact, Adam from Mind Pump and I were having a conversation, and he locked in a sub 6% mortgage rate on a property that he was looking at.
Yeah.
And he was questioning whether he should wait for the benefit of rate cuts. And I was like, no, don't wait. This is about as good as it's going to get, Chief.
Yeah.
And I'm happy he listened and he did lock it in. And now this article, originally unfortunate, I think Haroon pulled it up on AOL here, but I'm going to read some quotes here that I think are important from the article. Because if I toot my own horn, you know, it sounds self-serving.
Okay.
If another article toots my horn for me, you know.
Yeah.
You know what I mean, Daddy?
It solidifies.
Yeah.
Yeah.
You got it?
I got it.
All right.
Okay.
This from Fortune vis-a-vis AOL, if you're looking on the video podcast. The Federal Reserve's jumbo interest rate cut in mid-September, jumbo because it was more than 25 basis points, it was 50 basis points, was welcome news to prospective home buyers with the expectation that a lower federal funds rate would help push mortgage rates lower. Instead, the opposite has happened. Oh, you don't say. Huh. I wonder who may have called that. Know anybody?
I don't know. I think so.
I feel like we're being a little arrogant tonight.
It's okay. I like it.
Okay. Well, since Fed Chair Jerome Powell lowered interest rates by 50 basis points on September 18th, the average 30-year fixed mortgage rate has moved higher, not lower. According to data from Mortgage News Daily, the average 30-year fixed mortgage rate has jumped about 47 basis points since the Fed rate cut to 6.62% from 6.15% on average. Just to be clear, essentially what happened is they cut Fed funds by 50 basis points, but mortgage rates went up, not down by 50 basis points.
Wild, yeah.
Wild, but completely predictable. And this is a good point in time to pause and say, this is where economists get so far up their own sector's anus that they can't see the forest through the trees.
Like the real estate guys?
A lot of the real estate economists, Logan, a great one, right? From Housing Wire. I love Logan. Great guy, smart. He's got great hair.
Okay.
And his wasn't purchased like mine was. So.
Natural.
Yeah. But even Mark Zandy over at Moody's was calling for mortgage rates to drop a little bit. A lot of brilliant people were saying this was going to happen. And I'm like, how do you see it? This is such a fundamentally simple thing with the yield curve inversion. I mean, if you look back, yield curve inversions typically precede recessionary economies. Yeah, great. But if you skip all that nonsense and you say, okay, look, you're in an inflationary environment where things are costing you more money.
Right.
If you lower inflation, right, near term, meaning improving everybody's feelings on things, they feel more comfortable investing in the long term, right? Because they're not so worried about what am I going to do tomorrow to pay bills. They're worried about how am I going to get more money for next month, next year.
Yes.
It's just a simple shift in focus and priorities. It's just behavioral economics playing out, and nobody called it except for us. You know what I mean, Daddy?
Yeah.
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 All show long.
Let's go, baby.
So, yeah, this was completely predictable, and yet the market got it really wrong. And I'll never forget. You know, I've appeared on multiple podcasts before in the past, and now I'm getting a lot more selective on who's I'll show up to, because when you see some of these people speaking on podcasts, unless you're a subject matter expert or you're in the business or you see it for what it is, generally a giant commercial, unlike our show where we try to provide value.
Right.
These guys are generally full of shit. And I was watching a podcast with Pace Morby saying stuff that was wildly inaccurate, just completely misrepresenting things and doing it with this like arrogant bravado, which people go, oh, well, he's so arrogant and confident about it. He must be right.
Yeah, he must know what he's talking about.
No. I saw Ryan Pineda do this year after year after year. I've seen Dave Ramsey do it year after year after year.
Right. And you got to take into account, right? We've always talked about it on the show. You want to at least get some of your information or, count people as a trusted source if they've been through at least a cycle or two, right?
Yeah, but keep in mind too, all these people have something to sell you. And I get it. If someone's selling you merch or saying, hey, support us by supporting people who sponsor the show, that's different to me. If someone's saying, hey, look, I can help you make a lot of money if you buy my course. Okay, that's a convenient narrative.
Yeah.
No one's going to be like, hey, man, I got a pretty good way of making money. It works well for me. I mean, if you kind of want to try it out, it doesn't work for everybody. I mean, you can try the course. I mean, I don't know.
Yeah. Right.
It's not a great sales pitch.
No.
So what do? They come out and they're like, I can make you money.
Yeah.
You will make money if you follow my course. It's going to take some time. It's not for everybody.
Right.
Because in group, out group, right? Not for everybody.
Yeah.
Only the strong will survive.
Yeah.
There could be only one, like Highlander.
They got to know that you're pot committed.
Yeah. And they say that they have this key.
Right.
This opening to make you tons of money.
Yeah.
I was looking at some lawsuits for something else legally of a lot of the people who were selling Amazon stores and Walmart stores.
Okay.
And when you get into the economics of how much money these people were making, they were charging between $25,000 to $30,000 for one of these stores.
To set up the stores.
To set up the stores. And you look at the cadence with which they were selling these things. If they sold one a day, just one a day, that's 20, let's call it 20 grand a day. That's which is on the low end, right?
Yeah.
You do that 5 days a week, that's $100 grand a week. A week just selling Amazon stores. You get one person on social media to buy your stick. So for people to think this is not an incredibly, insanely lucrative thing for these people, it is.
Yeah.
Because when you think about it, what are they're setting a store up for you, right? That's not a tangible spend. They're going to pay for some services, and they're going to hire somebody off Fiverr like Haroon does.
Which sucks because, I mean, a lot of the information is free online if they just spend the time to,
Almost all of it.
Yeah.
And a lot of them have, like, you can get free Discords, this kind of stuff.
Yeah, YouTube University is real.
But it was a terrible business structure, and a lot of these gurus got sued for doing it. But I started looking through, and the light bulb went on. Like, that's why these guys start upping their courses to 10 grand and like these hot ticket items, right?
Okay.
Why try to sell, 10 $1,000 courses when you could sell one $10,000 course?
Yeah.
And they do, and you start doing the math. Let's say you sell again one $10,000 course a day times 5 days a week. You only work 5 days a week.
Mm-hmm.
50 grand a week. And then what? Your course is on autopilot because it's already pre-recorded and done.
That's it. Exactly. It's
like you don't have any other expense.
It's like a teacher, right? You build out the curriculum, and once the curriculum's built out, it's just on autopilot.
It's insanely lucrative for these people. So of course they go on these shows and these podcasts, talk about the economy and give you this level of certainty. It's all selling you.
So if you're a betting man though, because obviously this is a hot topic for a lot of people. A lot of people want to get into their first home still. When would you, if you were to guess? I mean, how long are we waiting for rates to come down?
I don't think
at least a little bit, enough to make it. I mean, even coming down half a point, right?
Historically speaking, you'll see some rate movement downward after the election.
Right, exactly.
Typically speaking, you see an incremental slight drop post-election. This one's going to be a bit unique because you have the election on November 5th.
Yeah.
Followed by an FOMC meeting on November 6th and 7th.
6th and 7th, yep.
So if there's a cut there, which now the rhetoric is that there won't be a cut, it's gone. We haven't really talked a whole lot about it in the last couple of weeks because it's been really
I got the odds here.
There's been a lot of volatility.